All right, guys, let's talk about credit cards or consumer debts. So you'll see a tab down at the bottom called consumer debts. Come in here. In this instance, we made up some debts for Jane and Joe, and just fill out the table. I'll expand this so we can see the whole thing. Fill out the table to the best of your ability. It doesn't have to be exact to the penny because it will change obviously every single month, but get it as close as you can. And in this instance, we just list that in this case, Jane has two credit cards. They got one joint, or pardon me, a credit card and a student loan. They got one joint credit card. Joe's got two cards. Jane's got an auto loan. So anything that's just debt, whether it's student loans, credit cards, um, something that can get paid off, I would list it here. And you can do it in any order initially, but write down everything you can, fill as much information as you can. And the part that you'll probably stop at is after you get to the interest rate and the minimum payment, this new component here is what the worksheet can help you do. So in this case, we recommend doing, the snowball method, which is you pay off the balance with the lowest balance first. Doesn't matter what the interest rate is. In this case, it happens to be 18%. This one happens to be 6. Look, if it push came to shove and you really wanted to, I don't care if you switch this and paid off the $4,100 before the 35, just because there is such a huge difference in the interest rate. But ultimately, guys, it's only because these balances are so close. If this was a $20,000 debt, I would say you pay off the $3,500 first because you'll free up $70 real quick that can then go towards this every month. So the snowball method says if you pay that extra, in this case, we'll go to 0. If you don't pay any extra, it shows the minimum payment. Well, guys, it tells you how long it would take to pay something off. So in this case, for a $2,300 debt, it would take them 94 months. So think about that, guys. 94 months is almost 8 years. So you get such a long time if they're only paying $46 a month at 18%. You're barely catching up. But if they say, hey, I'm going to throw $500 extra towards this, all of a sudden it gets paid off in 5 months, right? And they only paid $95 of interest on it. And then once that's paid off, you got this 546. You can come and put that towards this mortgage and all of a sudden, or this credit card or student loan. In this instance, 546 takes it from what would have been 58 months down to 6 and knock that out real quick. And all of a sudden you got 616. Well, guys, 616 towards this new debt, which would have been over 10, maybe 11 years, looks like. You can take that and say, guess what? Now we're down to 7 months and we get to knock it out. So if you were to do this and go all the way down on this table, you can go and say, okay, I got 827 more. I got 1127. You go from paying what would have been about $14,000 of interest to now paying literally a tenth of that and knocking that out in significantly less time. So guys, knock this out, do the snowball method, record your debts, know what's in front of you. Don't be scared and put every single disposable dollar. So in this instance, if you've been going through this in order, Joe and Jane, quit paying extra towards a mortgage, quit paying extra to 401ks and IRAs and things like that. Let's quit paying extra on college kids. Let's quit paying extra into a savings account. And they should be focusing every single dollar to getting rid of this bad debt. Mortgages are good debt, in my opinion, but let's get rid of this bad debt. And then once that's done, they can come back and start contributing all that extra cash because they're going to free up so much money every single month by paying all this off that they can then start building up their savings and growing wealth. If you have any questions, call us.